Hello, welcome back to another episode of The Next Big Bet, a podcast series brought to you by Creddinv Technologies. Today I have a very special guest to give us a lot of information about starting a startup. I have Divya Chandrasekaran today. She is a corporate lawyer with 13 years of experience in actually balancing the legal rigor with business strategies of startups. So, welcome, Divya.
Thank you so much for that little introduction. So, yes, I do bring about 13 years of experience working across, as an in-house counsel and also with top law firms. So that is what that's what we bring to the table, like a combination of understanding the business risks along with, the legal aspects of it. Yeah, and I think that's what also sets us apart. And yes, I've been running iPACT Legal, which is a very new age law firm with a small team, and we basically handle a lot of corporate and intellectual property matters, along with, of course, dispute resolution, real estates.
So it's really interesting to talk to a founder about setting up a startup.
Yes,
so
yes.
let's just begin with that itself, right? Like as a
Sure.
founder, if me being a founder, I have an idea in my mind. So when do I
Right.
start incorporating my firm? Like when does this incorporation come in scene?
When we have to talk about incorporations, one thing I'll always say is do not hurry into it. First, try to understand what is the structure, right, and what kind of an entity you want to first of all register. So, practically, if I should give you examples, I've seen a lot of startups coming to us saying like 3 years back I incorporated a company, but now my business plan has changed. Now we want to strike it down. So, incorporation is not just a cost and compliance in itself, but when you move ahead with an incorporation, even without a proper plan, what happens is, again, there's cost of incorporation. There's a lot of time and cost involved in the compliances that you have to follow. And if you don't want, again, an exist is in cost and a complete procedure in itself. So it's important that you first think, if you really want to go for an incorporation, I would say always go for the why you want to incorporate. Probably if you want go for investments, or if you want to hit a larger market, or you want to show to the market that you're a more regularized entity. Okay, so that's where the purpose of a private limited company or an LLP comes into picture, because of course when the compliances are a little more, the trust is also a little higher. Okay, however, yes, there is cost of incorporation, there is legal costs, there are also costs of compliances, which also a lot of people miss. So they just register, then there are compliance gaps, and then you'll have to pay penalty. So it's also, you should always be aware of what exactly do you want to even get into. Okay, so there's no exact time for it, but depending on how or why you want the incorporation.
Okay. So would it be like the product has to be at a stage, like for example, once it is in a market viable stage, like an MVP, they have an MVP ready, and maybe some founders would even have some clients ready, right? So before that is when they do the incorporation, or would it even be after that, or when they need investments?
Okay, so I don't say, I wouldn't say there's a set, process or timeline to do it, but it's more prudent when you have something concrete to even, invest your time, efforts into that, okay, and to see even see if it's even working out, right, even before you incorporate a company. And see, we've seen so many founders who just start solo, or with alongside a few partners, and then when things are more formalized, structured, then they go for an incorporation, right? Or similarly, when you want to do a lot of deals with larger companies, so there's a lot of background verification, and in those cases also, having an incorporation plays a major role. But however, I would say always take a more informed decision. Think through, yes, if this is the time I'm going to scale up, or if my product is ready, or I'm going to pitch to a larger audience, or when we're going to pitch to your investors. Right, so that's when it really comes into picture. And again, one very common question we keep getting from solo founders, they say, I want to incorporate a private limited company. It doesn't work like that. For a private limited company, or an LLP for that matter, we need a minimum of 2 people. Right, so it's important that you actually find a right partner even before getting into the incorporation stage.
Yes, I was about to ask you about
Yes.
that, because people usually do that, and they just
Yes.
come one founder and he wants to register the company.
So
like I want to get it into a private limited, but that doesn't work.
Right, so we get at least one query, say, or at least 2-3 queries a month for that matter,
Okay.
from solo founders saying, I have an idea, I have an investor to come in, but can we first, incorporate the
Incorporate it,
company? I'm like, see, OPC is
called as a one-person company. But however, even that we wouldn't really suggest
Okay.
to start with, because there are more compliances to it also, right? So it's much better to go for as a sole proprietorship, I'd say.
All right. Okay. So, if we have to talk about, especially in the experience of Creddinv, we've seen a lot of startups come in with LLPs, and we usually, our CA usually tells it's better to have a private limited over LLP.
Yes.
Can you elaborate on that?
LLP is a more regularized form of partnership. Okay, it's a most, when I say regularized, it's more governed, I'll say maybe a regulated, I'm sorry. So a regulated format of a partnership, okay? And a private limited company is a little more stringent because a lot more people are involved and the regulation is also more stringent. Okay, compared to maybe LLP, there are just few amount of filings, returns that you have to do. But however, in terms of a private limited company, there are more compliances, more filings that you have to be more transparent with the ROC. Okay, compared to an LLP. So when it comes to investors' confidence, obviously something which is more regulated, which is a more structured format. That is where customers and consumers, for that matter, when you look at a private limited company, it is a little more from trust perspective, I'd say.
Okay. So that is
So,
the
so
main
that
reason.
is the main difference. So,
All right.
and of course, I mean, from tax perspective, from the number of, increasing your, I mean, from investors' perspective, of course, in LLP, it is still a partnership, right? For you to get an equity, for you to, get a stake in the company, it makes a lot more sense.
For it to be a private limited company in the first place, right? Yeah.
That's true, yeah. Because most of
Yeah.
the investors, they come in asking for an equity share.
Yeah, so that defeats when if it's a LLP to ask for a partnership,
Exactly.
right?
So yeah, I
Yeah.
totally agree
Yeah.
with that. I'm seeing a lot, many investors and founders struggling hard to
Yes.
figure out if it has to be an LLP or they have to move to become a private limited company.
Right.
Talking about that, both LLP and private limited, like you said, we can't have one founder or one director. There has to be two or more. How do you think the agreement between these two or more founders should be incorporated?
Okay, so first, again, I'll step back one step, and I say first, it's mandatory to have a document. I mean, why I'm saying mandatory, not from a, it's not a legal mandate, but however, it saves a lot of time and efforts, in solving issues, right? So mostly, a lot of times we see, okay, you always want to do business with people you know. Okay, so obviously it's a friend, it's a family, or an extended connect who you actually feel the vibe. Okay, I think we can do it. But what happens is only when you get into it, you really know what are the problems, or even if there are any disputes, how do you handle it? So if you cannot have these discussions in the initial stage, it becomes a lot more difficult, at a later stage when there's a problem. Right, so it's even important to understand. So most of the times when we are negotiating the founders agreement and all, right, we see the disconnects right there.
Okay.
So trust me, it saves a lot of not just time, but it even saves the relationship in the first place.
All right. Okay. So does
Right.
it happen between, because of the amount they bring to the table?
Yeah.
Is it a 50-50 or how
See,
does it
initially it sounds okay. So there's no set, like a format of it should be a 50-50 only. It depends on how much you're bringing into the company, not just in terms of your monetary investment, but also in terms of your expertise. So there are a lot of times where people do give a 50% stake, even if you're bringing in a lot of, like expertise into the company, or it's just so a contract. It's just between the parties. There is, though in a lot of negotiations, people say this is industry standard and all that. There's nothing like that. It's just between the parties. So the Contract Act, the law allows you to, like within the boundaries of law, of course, the legal framework, that you can decide whatever you want between the parties. But yes, I would say always look at it from a long-term perspective. Not like, okay, today I have so much money, this much equity I'm taking, but you'll have to look at it from the long term also. Which I'm saying, like even if just two of you are starting, I'd say even at that point of time, just think through how you want the cap table to be. Like how much investments are you planning to give, and how much is each of you planning to dilute also. Okay, it shouldn't be a case where when it comes to it, and then see, it doesn't look good in front of the investor also, right? Like you don't have clarity on what you want to do.
That happens,
So I think these are the discussions. I would still say it's like have a preliminary discussion at the initial phase, get into a signed contract.
Okay.
Of course, you can always change the contracts. You can sign a fresh one, but still have something in place where both parties have clarity on what you're getting into.
Right. That makes a lot of sense. And also another thing that I've been seeing is partners or directors leaving the company in the initial stage itself. Sometimes during the early stage, certain partners leave the company. So how do you think that can be accommodated in the initial stage of documenting? Because something like vesting or
So vesting is, yes, one of the good options, because like even in case of ESOPs and everywhere, why the vesting concept is a certain percentage keeps accruing, right? And is what you will reap after a stagnated period of time. Okay, so that's how it's designed. So that way it keeps you motivated that when I need it, I have to stay in the company. Okay, and again, it is it differs from, there's no one size fit for all. Like it differs from transaction to transaction. Okay, say we also know a lot of founders, when they're just getting into a company incorporation, right? They just say, okay, I'll bring in my mother or someone, just because you need one more person in the company, right? So they say, okay, they are my business partner, but in those cases, you need to have a simple exit. Right? If you want to have your family member, though they're not really interested in the business, say for 6 months, 1 year, it doesn't make sense. So it's important you structure it in such a way that if this person is very crucial, okay, and so that's also from the perspective of investors. Okay, the investors are coming in only trusting the the initial team, the founding team, right? So if you see in any investment document, the most important one is a lock-in clause, where they say the investor cannot exit, within say a 1 year tenure or a 2 years tenure, because see, they are bringing in money only as a matter of trust in the business, right? So it's not a loan, it's not a debenture where they have a guarantee of return. Right? So I think that amount of comfort you'll also be able to give the investors to say that, no, I'm serious about my business. Right? You say I'm a founder, but I'll exit in a year. I don't want to agree to a lock-in. So that's why I'm telling you. So these discussions actually, it makes or breaks the deal.
Okay.
Right? So sometimes even the investors sense that, okay, they're not serious about it. He's not ready to give me a 2-year lock-in from exit. That gives you the doubts, right?
Right, that works on the psyche.
Yes.
Also, another thing I have been seeing with these initial teams, right? The founders usually get excited with certain members joining the team because they bring in a lot of expertise, or usually in tech-enabled companies, right? There are certain early members who bring in IPs and things like that.
Right.
So certain, I wouldn't say all, but certain founders get very excited about it and they start sharing sweat equity. With these people. So what is your take on it?
See, okay, so sweat equity, ESOPs are all things where, because see, from a founder's perspective also, like I said, since I've been there, so I also know the challenges of the initial cash flow crunch, or for you to, commit to large number or large sums of money, or, towards the salaries to bring in, like experts. So there's this concept of advisory shares, but there's nothing called as an advisory shares that's issued. So what they do is either they go through a sweat equity or a private placement. But what they do, sweat equity, the benefit is it's for any consideration other than cash. And for people when they're breaking the sweat, that's why it's called as sweat equity, right? And when you're bringing in when you're bringing in any IP into the company, so these are cases when companies do issue sweat equities. Of course, there are several compliances and you need to look at how it has to be issued also, but yes, they do that. I wouldn't say it's right or wrong. It depends on how crucial that person is and how much are you, to what extent are you giving in the sweat equity also.
All right, okay. Coming to ESOPs, how early in a venture should the founder think about giving ESOPs?
So again, I'll draw parallels to this only. It's also about how important are these employees at that point of time. Okay, see, one thing we'll also have to look at from the perspective of employees is even they are taking a risk, joining a company in a very initial phase. So ESOPs kind of works, like psychologically in both minds, because when you have the vesting period and all that, even so it's like giving a portion of ownership to your employees, right? So if you really feel, okay, my product is or my services is gaining momentum and I really need a solid team, but I do not have immediate cash to like satisfy their requirements or whatever, so ESOPs is a little deferred kind of like an incentive, right? So when your employees also start working towards a success because they know that they have skin in the game. That is all it boils down to by the end of it. So there's no set time of this is exactly the time, like immediately you have, I mean, as soon as you employ people or after a certain number of employees, it's not like that. And it depends also, like if you really feel that, okay, I see a growth, but I want this team to stay with me.
Right. Yeah.
Okay.
Makes sense.
Yes.
So when we start when a founder starts thinking about taking investments, what route should he go with? Like, for example, should he take a safe at the for the first time, or should he immediately go for CCDs? What kind of a thought process should go behind this?
This is more from the perspective of an investor, right? So safes is nothing but your simple agreements for future equity.
Exactly.
So is your investor ready to take that?
Okay.
Is number one. And secondly, when we're talking about CCDs, right, that is, I look at it more like best of both worlds, because your investor is giving a debenture, which is firstly in the form of it's like a loan, right? So they do get benefits out of that, and then at later point of time it also gets converted.
Yes.
Okay, so again, it's more from the investor's perspective.
Okay.
Do you want to directly go for an equity investment, or you want to, and there are other options also. You can even advance a loan which can further be converted into equity. So these are all the things, as I said, it's between the parties.
Okay.
The interests and the pros and cons of the business transaction. How do you want to structure it? And this also plays a lot of major role in negotiation.
Right.
To
So,
to say what I'm ready for. How are we bridging that gap?
Okay, that is why I was wondering from a founder's perspective, right? Should he actually think about it? Like, am I taking the money in a wrong way or in the right way? Like, how does he decide on that? If he has to go, especially why I'm asking this is because a lot of startups in the very initial stage, like they just have one unit ready in their inventory, right? They want to scale up, even their inventory has to build, right? So for that they need money, and they're not ready to take CCDs, and they usually go for the safes. Because they can like take the money and later give equity to them. So is it okay to take such kind of an
See, as I said, it's okay. See, whatever is best for the founder, they would choose that.
Okay.
At the same time, talking from an investor's perspective, there is money,
real money that's that's involved there, right? So they will need a guarantee. So as you said, when the inventory is so low, or you're just getting started, is someone even ready to take that, sign the doc, and wait for the equity to come at a later point of time?
Okay, so
They're okay, nothing like it.
yeah, but is it okay for another investor? So for example, if I have already invested with a safe in one of the companies, and then there's a second investor, maybe you want to invest in the same company, would you be okay looking at an investor who's been given a safe?
So again, this goes back to my very first discussion of having clarity on the cap table. How much do you want to dilute, right? And again, ensure that you're within that limits. Number one. Secondly, even the second person coming in,
He's going to look at how much has been diluted already.
Exactly, yes.
Right? So it is not just about, so they look at not just the fully diluted, if you have any commitments, which also includes your ESOPs, your sweat equity. So you need to have a clear structure of how much percentage you want to allocate to each of these baskets.
Okay.
So yes, again, from the investor's perspective, that's psychologically, are they ready for it?
Okay.
And as long as if you have the confidence that, okay, this company is going to do well, it makes sense to trust them now with this.
Okay.
Anyways, it's an agreement by the end of the day, right?
Yes.
It's an agreement, so
Yeah.
yes.
So another thing from an investor's perspective, what they look when they look for investments into a startup is the valuation. Yes. So from a legal perspective, what do you have to talk about valuations, and when should it come to the table?
So from the investor's perspective, I think that's a number that's on the papers, right? Something that shows that this company's potential, right? When I'm investing on, if I have to think from their perspective, when I want to invest on something, I really need to see something concrete more than just a pitch deck, right? If it's a pitch deck, just saying, okay, this is what we plan to do, but where are you now? I think that is where it's important. But of course, if there are foreign investments, there are a lot of regulations that there has to be a valuation, which also becomes a legal requirement where you cannot purchase for an amount less than what is valued.
Right.
Okay,
Makes sense.
so those are the situations where it's mandatory legally. Yes, you have to get a valuation, and similarly, again for fresh issues, also sometimes when the company is bringing in money, right? So it's important to have the valuation first, so that you need to know, even from tax perspective, right?
Yes.
So what is this is a face value, this is the premium at which we are issuing, right? It shouldn't affect either of the parties.
Definitely,
Yes.
yes. And how does the legal work and the tax exemptions work hand in hand? Like, how do you look at them?
Based on what I've worked with in the past, it is into different, like slots, I'd say.
Okay.
See, like certain industries get exemptions,
All right.
right? If you're, say, into EV, you get some kind of a benefit. So one
Right.
aspect you have to look at is if you're getting into a more sustainable kind of an industry, or, where there are actually exemptions, then you have to really make use of that. Okay, number one. Secondly, startups, right? So startups do get a certain benefit, of a holiday window from, which is a tax exemption for certain years out of your first 10 years, which really makes a lot of difference, right? So then, but it's important that you get registered with the Startup India initiative. And to avail the benefits, okay? And one more thing is incorporating in another country.
Yes.
Yes, okay. See, we see a lot of that, like now that with, Middle East, developing people want to invest in Dubai, or they want to, I'm sorry, not invest, they want to incorporate in Dubai, or they want to incorporate in any of the tax haven countries.
Yes.
Okay, so, but there also I would always say consult a tax expert there, because one major, at least which I have seen in person, is there's something called as POEM, which is the place of effective management as per our income tax. So what happens is you just incorporate a company there, and your entire management sits here. All decisions are taken here. Your inventories are here. Your people are here. So technically, just having it there, you might land up paying tax in India as well, because our act clearly says if the poem is abroad, then okay. If it's in India, you're taking all decisions in India. If more than 50% of your expense on employees is in India, which people don't really they miss out on these small nuances, and you'll end up paying instead of saving, you'll end up paying double taxes, right? So I
Yes.
think these are things we need to really talk to experts, and then take a decision if you really want to do it.
Right,
Okay, but
right.
mostly I see the purpose people do, register in other countries, is to show that we have a global presence.
Exactly.
Number one.
Yes.
Secondly, I think it makes a lot more sense if you need logistics in that country.
Yes.
Right.
Depends,
Otherwise-
again, depends on the product, I guess.
Yes, if it makes sense
yes.
to have, or when there's an investor requirements, when there are investors in other countries, they would like to know, okay, fine, there's someone in like my country,
Exactly.
and I know these are a little more regulated in my country.
True,
right?
yeah. Talking
So-
about the investors, actually, at least very recently we came across this startup. So they are not really from the US, but they want to start in the US because they feel the investors in the US would be more interested in their product.
Yes,
Even though the product is for India, only because
Right.
the investors are from the US, they want to incorporate in the US, and they came to us asking for advice. So, what would you advise them in that?
Again, it's the same thing, like first look at it from business perspective. Does it make business sense?
Okay.
Again, the same concept, whether you want to incorporate in India or any other country, there is cost, there is compliance.
Yes.
And when you're incorporating in other countries, you have to, I'd say, even have a local council there. Right?
Okay.
Because to know that the laws are different in almost every country.
True.
Right? So you should even be aware of what you're doing is even legal or permitted in that country, right? To start
right.
with. So you need to do that amount of research, and if it really makes business sense, if
Okay.
say you really feel, okay, I'll get a good traction, or there's a market there, or I get investors because, or I'll get investor confidence because of that.
Okay.
I'm saying don't just go for it based on your guesses that I might get investors there.
True.
Don't get into it, because you are incorporating a company. And even in India, when I say these compliance messes, right, sometimes it will also affect your DIN number, like your director identification number. It will be deactivated if you are part of a company who's not really, like filed their annual returns and stuff for several years. So which means it will also bar you from being a director in another company. It's also going to affect you that way.
Okay.
Right?
That's a little scary.
Yes. So always say, like, being compliant is there's no compromise there, right? So be aware of what you're getting into is what I would say.
Exactly. So obviously that means a lot of research has to go. I mean, the founder has to do a
Absolutely.
lot of research before he takes such decisions. So do you think there are enough what to say? Because now everything is very, very much on the tech side, right?
Right.
If I want to know about something, I'm just gonna go Google it or anything.
Correct.
So for that kind of information, the legal information, do you think there are tools in India at the moment that's giving you the perfect information, or how does the
See,
research work?
legal tech is really on the rise now. Okay, I was at a legal tech event even last evening. Okay, I'm
Okay.
really seeing a lot of people, and that's something even I'm quite excited about.
Okay.
Because this is there to make our lives also easier. Okay, but at the same time to say, are we with like a perfect tool? I'm not really sure. Okay, and currently I know from a company's perspective, people use it more when you have larger, more compliances or more contracts. Then it makes sense for you to invest in that legal technology to start with. Right, there's going to be integration, there's going to be cost, a lot of things, but again, that's a business decision. I would say if you're in a highly regulated industry, say like finance, like if you're getting an NBFC license, or even if you're a startup, right, it's highly regulated. So in those cases there are several compliance softwares which kinds of give you the trigger so that you do not miss the deadlines.
Right.
Okay, so these tools have been a little helpful.
Okay.
But anything I would say, always reach out to the experts,
Right.
even for a suggestion of which software you can use. I think we always need a little brains behind the AI, also human brain behind the AI also, to tell you if it even makes sense to invest in that.
Totally makes
Yeah.
sense. Yeah. Especially with the rise of Razorpay X recently, like they have come up with this software where any startup can use their platform to do all the taxes, the legal stuff and everything. So do you think that will actually I wouldn't say totally keep the CAs away, but still, what kind of use would that be, or for startups?
As from what I see today, I'm very confident that I'm not losing my job.
Okay.
Okay, I'm telling you why is because see, our kind of profession, you need a lot of strategic advisory.
Right.
Right. See, and I see a lot of founders, or even a lot of, even settled, clients who are at a more settled business, right? Or even if they're in business for a couple of years. So what they do is they just download drafts and bring it to us. Okay, because I know they subconsciously feel that, okay, drafting is expensive, review is lesser. But trust me, review takes a lot more time. And I really have to tell them that if you sign this, you will be in soup. Because when you are actually, it also depends on what, and people say, no, I'm very good at giving prompts. Okay, you're good at giving prompts. But is it going to ask you the right questions?
True.
Right? So probably if that is also incorporated, probably if the AI is also going to bring in, try to understand, then maybe that's going to be a lot more helpful, not just for them, for us also.
Okay.
Right?
Thank you so much for telling that, because I think yes, we even Creddinv, we are actually having legal tech startups raising investments through
Right.
us. So yes, this is actually a good thing for
Yes.
us to add on to that one. And I think we'll just wrap up the podcast. We've been talking
I
about
know.
legal
Absolutely.
incorporations.
Right.
What is that one myth you would like to burst for startup founders about legal and compliance?
So they always feel that's useless expense, I'd say.
Okay, because I what I see is, as much as founders are ready to invest in marketing or sales, which I totally understand, because those are the things that's going to convert into money. But how confident are we that this investment is going to get me so many leads? It's a risk, right? Likewise, but people are not really ready to invest in legal and compliance part, because for them, the focus is more on building business. So I would say one small tip is, always read the contract that you want to sign completely. You will not sign it.
Okay.
If you actually read the document that you're signing, you will automatically reach out to the experts.
All right.
Okay, but so I'll always say, maybe allocate a little bit. So it's always safer than being sorry. Okay, I would say not even an insurance, it's even better than that. At least in an insurance, you keep paying premium and you'll have to prove that something actually went wrong. But, when it comes to legal, we're trying to ensure that nothing goes wrong.
Okay.
Right?
That's very well said. So thank you for educating us and everyone.
I'm really glad if it helps. Yeah.
Yes. Thank you. We'll meet you on the next episode.